Hey folks, welcome to a product review at Finominal. Today we're going to look at Cambria's 1 billion shareholder yield ETF that trades under the ticker SYLD. Now, the premise of that ETF is that dividend yield is a flawed metric for selecting stocks and that it is more effective when combined with companies that buy back their shares or that pay down their debt. And let's have a look in terms of how well this investment philosophy has worked. And we're first going to do a quick benchmarking exercise. Now we see that the suggested benchmark is the Russell 2000 Value Index on our Alpha Analyzer tool. And that is slightly different than what the manager, like Cambria, is posting on its fact sheet, because that is the S&P 500. But if you look at the R-squared from regression analysis, the tracking error, the correlation, it does seem from our perspective that the Russell 2000 Value Index is the more appropriate benchmark. Now, from performance perspective, we can see that the ETF has basically performed in line with the Russell 2000 Value Index since its inception in 2013 to 2020, but significantly outperformed in the post-COVID-19 period. And today has almost generated the same returns as the S&P 500 over that entire time period. Now we can also see that in terms of from an exit return chart, where this nice outperformance kicked off in 2021 and continues to this day. Now let's see in terms of what has been driving the risk and return of this product. But we're first going to switch to the right benchmark. And next we're going to run a returns-based factor exposure analysis, where we are simply going to look at the equity betas over time. Now, what we see is that there is consistently positive exposure to the value factor and the quality factor over time. We do see that the exposure to momentum was kind of flat, and there was slightly negative exposure to low volatility and size. Now, stated differently, this means that this portfolio, which is comprised of 100 equal-weighted stocks, has companies that are cheap but have high quality characteristics, that the stocks are neither out or underperforming, and that it's slightly more volatile, and the companies are slightly larger than the average stock in the Russell 2000 Value Index. And overall, the value and quality characteristics are kind of expected if you think about selecting stocks on dividend yield, which is a proxy for value, and companies that also buy back shares, which is on profitability, because you need to profitable to buy back shares, otherwise you don't have the means to do so. Now, let's move on to the alpha generation. And what we do see is that there's been consistent outperformance in 10 out of 12 years. There is consistent alpha generation in 8 out of 11 years, and also that the ETF has a very high active share. And that's great. And if we look at that from a cumulative return contribution, we see that most of the returns of this ETF are effectively explained by the market. Equity factors contributed very little. And most of the return we actually cannot explain. And the unexplained is, of course, the alpha. And we can see that the alpha generation was basically consistent from day one and has grown over time, which is great to see. Having said that, just because we can't explain the return with these equity factors and asset classes doesn't mean that it's particularly or needs to be unique. And another way of looking at that is simply at benchmarking that shareholder yield ETF versus some peers. So let's do that. And we're going to use 3 dividend yielding ETFs as well as Russell 2000 Value Index. And we're going to kick off with a simple performance analysis. So we see that the shareholder yield ETF, SYLD, has outperformed over the period since 2018. But again, as we've seen earlier, that most of the outperformance can be attributed to that 2021 period. Now, the other point that's worth mentioning is that if you look at SYLD from a volatility perspective, I think it's actually the highest volatility compared to those other dividend yielding products, which are from Invesco, First Trust, and iShares. We can see the drawdown with negative 45% was also on the higher side. Both products from First Trust and iShares had a much lower drawdown. And that, of course, reflects in a Sharpe ratio of the shareholder yield ETF that is on the lower side, especially compared to the First Trust and the iShares product. Now, if you do wonder what the dividend yield is, actually the dividend yield of the shareholder yield ETF is only 2.4%. That's kind of expected because it's not just selecting stocks on dividend yield, but also on buybacks and paying down debt. But you could challenge it, right? That from a risk-adjusted perspective hasn't led to the highest Sharpe ratio. And so some of those other products have much higher dividend yields. Now, just seeing in terms of which of those products would be more similar, we can have conduct a style-based analysis. And so what we do see is the Cambria product, which is that turquoise dot, that it kind of like ranks low market cap and cheap as we've seen earlier. You can see it's quite similar. And actually, let me improve this by selecting the right benchmark over here. That makes it more meaningful. That the product that is likely more similar to it is the one from First Trust, because we can see in all of these kind of like segments, they're quite close to each other. Now, and First Trust is a dividend achievers ETF. Now, that kind of like is one way to analyze the shareholder yield ETF on a standalone basis, where we looked at alpha generation, as well as compared to some peers. If you are wondering, is it kind of like a cheaper alternative? We can have a quick look at that. We have a fee reducer tool, and to my knowledge, there are not other products that look at buybacks and paying down debt in a similar way as the shareholder yield ETF has done. And indeed, ironically, we come up with the same peer, which is a First Trust rising dividend ETF that is slightly cheaper at 49 basis points versus 59. But as we've seen a few minutes ago, the performance has been almost identical over the entire time period. And I think you actually generated a higher Sharpe ratio, and you're also getting that's almost similar yield. So that kind of concludes our analysis of the shareholder yield ETF. So it's a nice framework in the sense of acknowledging that many companies choose not to distribute cash back to investors via dividends, but instead they are deciding to delever, which is great. That improves the quality aspects, or to buy back shares, right? A lot of tech companies have been doing that. So from a framework perspective, it's quite alluring. Having said that, if you do look at the result over this 10-year period, there's not a lot of difference to kind of like dividend products that also have some quality characteristics like RDBY, and they're also cheaper. And you could go back to, for example, this other product from iShares, which charges, if I'm correct, a mere 15 basis points, and giving a similar performance. And that kind of concludes our analysis of the shareholder yield ETF, right? So it's a nice framework, but if you actually look at the results over this 10-year track record, it's not as impressive as we perhaps wish it would be. Hope that was helpful. Have a nice day.